Welcome back everyone to StrategyQuant's channel. My name is Ali Casey. In today's video, I will continue the simple strategy that we built on gold futures in the previous video. If you didn't watch that, please do. There should be a link in the comment below or in the link top left corner. And so once you do that, we can build a portfolio out of it, and I'll show you how to do that and how to find out the capitalization requirement to do that portfolio, and what can you do to increase the profitability of that portfolio. So let's jump in. Welcome back everyone. Thank you for joining me. Before we continue, I would like to ask you to please smash the like button so Google Algos can push the video to other traders, as it will help the channel grow. Now, in the previous video, as I mentioned, we built a simple strategy on gold. I forgot to show you in that strategy that you need to enter on the break of high or low on the long and short side. And I will show you in the software. So let's jump in. Welcome back traders to StrategyQuant's channel. My name is Ali Casey. In this video, I will teach you how to build a portfolio of the simple strategy, simple gold strategy that we did in a previous video. If you didn't watch that, please do so. There should be a link in the corner or in the description below. So let's jump in. The strategy was very simple. If the close is a mean reversion strategy, if the close is lower than the close of yesterday, then we'll go long. And if the close is greater than the close of yesterday, we'll go short. And then we just added a filter, and I put the filter at 25 for long and 30 for short. And of course, this will be applied the same thing for all instruments. Now, I forgot to mention in the last video that this strategy, you don't go long next day on market. You will go long next day when it breaks the high. So remember, we are going long here. There is a dip, and then we'll go long the next day. But we want a confirmation, and that confirmation is that we break the high of yesterday. And of course, on the short, we break the low of yesterday. And you do this by adding enter at stop. So I can build this from scratch. Usually you have a enter at market. So usually you will have this. So instead you delete this, and then you add enter at stop. And once you have the stop, just you use the formula and you just put the daily high. And for the short is the daily low. And of course you go short. For the long is daily high and you go long. And that's it. So this strategy is, this is on gold. Let's run it again. And then of course you can run it on different instruments. So you can then, let's say, run it on now, what I also did, I did the strategies only on the data from 2009 till 2017. So you can do that by going here. It just reset the date, start from 2009 and go to. So this is the data I'm doing it on. So you run the full backtest. And then you take this, because we cannot test on multiple instruments. So we need to take this to the retester to do a portfolio. So there's an easy way to do this, and you can just say save to retester. And just let's call it, because I already have some. So let's call this test, save. And now when you go to retester, the strategy will be here. So I come here, double click on it, go to strategy config, apply strategy configuration, because what we want is we want to test the strategy on all data. So I come here, apply to retester, yes. And then in data, now when you do this, you need to pick the out of sample. So January 2018 till 21, that's my out of sample. So it will be highlighted. So again, go progress, just do it again. It will replace this one. And now you can see I have a highlighted out of sample. And the reason is because you have different data on out of sample. So you can actually, let's see. So see, this data is highlighted. This is the out of sample data. So you can filter on it and do whatever you like. Okay, now, so I tested, let me delete this one. So I tested these crude and CT, GC, J6, and so on and so forth. I put them all here, I tested them, and then I combined all of them. So you click on all of them and you go portfolio, merge strategies. When you merge strategies, you're merging a simulated portfolio. That means the SQX actually will not run the logic, it will just combine the trades. So that's what you're doing. So then we do that, and this is the portfolio I did. So that's the portfolio. And the reason I did this, because I want to show you this. So crude oil, for example, obviously is doing very well in the out of sample, no need to worry. This one is also had a new high. So let me bring this down. And gold also had new high. J6, new high. NG, which is natural gas. So NG is actually going down. Since the test, we tested till 2018, it was going down, and now it went even down further. And platinum, again, no new high after 2016. And this is silver, mini silver, making new high, and wheat is not making new high. The reason I'm showing you this is usually because we tested, well, I tested since 2018. And in 2018, this was good. When I looked at this chart all the way here, the numbers were good. And I assumed that I don't have the data. So then when you test till 2018, that's it. Then your decision should be based on that. You cannot come back then and say, oh, okay, but now between 2018 and 21, it didn't do well, so let me get rid of it. So that's the reason I kept the bad strategies here. Well, they're not bad, but they're not performing as they're supposed to. So this is the portfolio, and the nice thing here is then you can do, of course, you can do so many things, but let's compute the, of course, if you can do daily and compute the correlation, all of them will be good. This is mini silver that is highly correlated with the big contract silver. But you need to go monthly, because remember, these are daily strategies. So it's no sense computing on daily. Obviously, they will be not correlated. On monthly, we can see now some correlations. So mainly the gasoline with the oil, and then of course, the silver. Now it's more correlated with its big brother. And then we have the bonds. So the bonds, the 10-year with the 5-year and the 10-year with the treasury bond, they are correlated. So that's portfolio one. Now I got rid of the some of them, the correlated, and I left only by mistake the gasoline and the oil. So this, you should keep one of them only, either the oil or the gasoline. And of course, I can just delete it now, but the problem is the next coming data is already done, and that was already including these guys. But as you can see, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, because you're going to delete one of them. So there are 9 futures in this portfolio. They are all using this logic. Close less than the close before, ADX above 25, enter at high, and then for short, close greater than the yesterday close, ADX above 30, then enter at low. All of these strategies are using that logic. There is no optimization, no nothing. And I only tested the data till 2018, and then came back here and found out what's the rest of the data looks like. And as you saw, some of them doesn't look good. But the nice thing is, in a portfolio, it doesn't matter if you have some strategies not doing well, some will do well. And so you can see almost every year except 2017, I'm getting new highs. So 2017 was included in the in sample, and 2018 and above is out of sample. And you can see every year we're doing a new high, even though some strategies didn't do as well. And that's the power of portfolio. This portfolio is not tradable yet. And you might say, well, why is that? Because there is no capitalization. And this is a 1 out of thousands of scenarios. Of course, the best way to come up with capitalization is through Monte Carlo testing, which we have in the cross robustness check. So to do Monte Carlo in SQX, it's for a portfolio is limited. So if you come back to the portfolio, so this is the portfolio we want, and these are the trades. So you can see it's all the symbols are here, crude. Now you can export this data, of course. You can export it as CSV, and then you can import it anywhere else in Excel or anywhere else. Now, I showed you this package before. And basically what this package is, I imported the trades, and I can show you. So here are the same trades. You can see the symbol, and I'm trading one contract for all of them. We have 17 trades. And we have this curve, which is end up at 355,000 if we start with 35,000. The nice thing now you can do is you can do proper capitalization to find out what's the capital requirement. So if we go set up, see, I can first of all set up the contract as futures, and then I can decide my account and the maximum size limit. And remember, that was without commission. I'm just gonna add $50 commission for both in and out with slippage. So let's apply that. This should go down now, 355,000, and now it's 258,000 because of the commission for all trades. See here, I put initial margin per contract. Now, this margin per contract is different per instrument. And if I want to do this even properly, I need to switch and import oil alone and wheat alone and bonds alone. But I can make things easier on myself, and I just give $10,000 per contract for every instrument in this portfolio. And now I can do my Monte Carlo testing. Now this gives me much better idea, because now it's more detailed, and I can see now at 99.7 I am guaranteed a loss. And also I have these little numbers where I ask it to calculate this. So I have probability that maximum percent drawdown will be less than 40%, 91%. So I have 91% chance that my drawdown will be less than 40%. And you can do this in here. So in Monte Carlo setting, I calculate this. I ask it to calculate the probability of maximum drawdown of less than 40% and risk of ruin of at least 5%. So this is the advantage of this software, is you can do this. The second advantage is, of course, you can do position sizing properly. And what I mean by that is, let's do it. So position sizing. So currently we have fixed contract 1. So I'm trading 1 every time. Let's add 5. And this is good. So here at 99.4%, I'm guaranteed above 3 million. Remember, originally we were making 250K. So same system, same everything. Now we're just playing with position sizing, but properly. And so this method takes into account, because I can show you. So let it finish the calculation. We end up with 4.3 million. And now if I show you the equity trades, you can see that we start with 1, go to 2, go back to 1, 2, 8, 7, 7, 10, 15. Slowly we go up in contracts to a maximum of 25, because I limit my contract in the settings to 25. If I add that, that will change everything. But I say 25 because this will remove any slippage. It's easy to trade 25 contracts. And this is what the power of this software. It calculates position sizing based on contract and based on initial margin requirement. So based on this, now my capitalization is 35,000. The performance. These are my returns. So 2008 is a loss. I have only oil in 2008. So then every year is profitable, and some year are more than 500,000, some year are less. But we are up and down. Remember, we stopped at 17, so 2018 is out of sample, 2019, 2020, 2021. These are all out of samples. And then you have the monthly. In monthly, of course, you're going to have some down months. And then, of course, weekly, you will have more down weekly. This is the summary. So we're doing long and short. Both of them are profitable, which is really good. And the longest drawdown is almost 3 years. In this system, if we see the Monte Carlo results, we can see what is the percentage. So here, the percent that I will have a maximum drawdown of 40%, it's only 25% chance. So that means I have 75% chance of having a bigger drawdown. But how do you get rid of this? You get rid of this by increasing the starting capital, or by not doing a position sizing until you are at a certain limit. Now that's a more advanced topic, but the result is I want to show you this. Is basically you can do. We started with really a simple system, build a portfolio, and then do position sizing. And then really within 10 years, you go from, let's say, 50K to at least 2 million, which is huge. You're quadruple or 6x your starting account. That only can be done by portfolio and position sizing. So I know it's a heavy subject, but I hope this opened your mind to some other possibilities. If you have any questions, please do post them below. And if you are in my Discord server, of course, you can ask there. I'll be happy to answer them. Great, you made it to the end of the video. It was a little bit long, I know, but hopefully it was useful. I wanted to show you how to build a portfolio and how to use other packages to find out the capitalization requirement, because that's really an important step in building a portfolio. The capitalization of any portfolio is actually the most important step, so you don't get wiped out, because if you wiped out, then you cannot trade anymore. So that defeats the whole purpose of making money. You need to always be able to play the game to make money. So capitalization is actually a huge part, and the only way to find out is through running a Monte Carlo simulation on the whole portfolio, taking into consideration the margin requirements for each future contract. Don't forget, if you have any questions, please do so and comment below, and I'll be happy to answer them. And if you are in my Discord server, please do so there, and I'll also be happy to answer them. If you want to join my Discord server, you can do so through the Patreon link down below. And if you want to hold cryptos and gain interest on it, don't forget to use my BlockFi link down below, where you can get up to $250 in Bitcoin if you deposit more than $100. And as always, smash the like button, hit the subscription button and the notification bell, so you'll be notified when a new video gets uploaded to the channel. And until the next video, stay safe, and I'll see you soon.